Hello everybody, Jackson here with the Well Squad. Today we'll be talking about a different measure that a lot of people don't use when investing. It's called the ROIC, Return of Invested Capital. It's very important, but we're looking at ROIC.ai to give us this measure today. So looking at Microsoft, one of the biggest, actually the second largest company out there right now, $1.865 trillion market cap. And we're looking at the ROIC, return on investing capital. So you have to ask yourself, you give these people $100, you give them $100, they're going to return 26% in 1 year of your money back, and that's pretty dang good. And the whole point of this ROIC measure is to ask yourself, are these people running the business, are they good at allocating capital? Are they good at putting money where it needs to go, where it should go, and getting a return? So this is Microsoft, of course, 26.1% in the last 12 months. TTM is trailing 12 months. We're looking at 26.1%. Let's look at a random company like we could do Shopify. Okay. So different type of business, not too old. It's pretty dang new, and we're looking at the ROIC negative 31.1%. Okay. So not only is the historical track record important, because you could see it had last year's 23.1, that's pretty good, but the track record is important too, because if you can see, wow, it's getting out, it's getting profitable, yet we are, it's expected to lose money next year, down $2.54 a share, then it is not a sustainable practice to rely on that ROIC alone. You have to look at the track record, you have to look at everything else, but it's a very, very good measure of where these leaders of the business put their money. So looking at Microsoft, you have to ask yourself, is a 26.1% a good return? And I would say yes, of course it is. So let's look at a stock similar to Microsoft. We're looking at Apple. Similar as in market cap, the two largest. ROIC of 50.2% in the last, actually that's just 2022, so 50.2%. And a lot of sites give a lot of different measures, so it's hard to rely on one. It's best if you just do it yourself, and there's a formula for it, but for the sake of the video I'm not going to do that. But in reality, you should just be calculating all these different ratios and metrics yourself, just to get a full glimpse of what the actual company you're looking at and the valuation. To do that, look up sec.gov/edgar, and you will find the recent 10Ks, 10Qs for that information, for the financial information. But ROIC, very important measure. It basically looks at well, there's three measures that FinViz provides us: the return on assets, return on equity, and the return on investment. ROI and ROIC is similar, but not 100% similar. So ROIC, completely different measure. You're looking at the return on invested capital. So we look at a company like Apple. Of course, it's doing well, right? The money invested in the company, where the leaders allocate that money and where it goes, returns a lot, like 50% we saw. So another company that I could think of, Goldman Sachs. Let's look at Goldman Sachs. ROIC of 1.6%. So of course it's different industries, and we could also even look at like Sony, right? Different country even, but similar industry, 4.9%. Look at Google, similar industry to Microsoft and Apple, technology, internet, 23%, so not as good. Anyways, guys, this is just a video to show you this measure that you may have not known before. The ROIC, it's very useful. Look at it in terms of efficiency for a company. That's the video. Thank you for watching.